Retail investors are quietly changing the Bitcoin landscape. Their steady accumulation is draining coins from exchanges and reshaping market risk. Bitcoin has spent the past month stuck in a downward trend, with price consolidating below key resistance and sentiment still cautious. Macroeconomic data offers little support, and many traders are waiting on the sidelines for a clear direction. On-chain data tells a different story. Exchange balances have just recorded their lowest level since early 2021. In the past week alone, more than 23,385 Bitcoin have left trading platforms worth over $2.15 billion at recent prices. That kind of outflow usually signals growing conviction among long-term holders. When fewer coins sit on exchanges, there is simply less immediate supply ready to be sold into weakness. Selling pressure fades, and even modest new demand can have an outsized impact on price. The Bitcoin Trend Accumulation Score confirms this shift. Small wallets are aggressively adding to their stacks, while larger cohorts accumulate more slowly but still in a positive direction. Distribution has softened at current levels, and the market looks increasingly driven by patient retail buyers rather than fast-moving speculators. For short-term traders, this creates a tricky environment. Price action still respects the broader downward channel, yet underlying supply dynamics look increasingly bullish. Bears point to weak macro conditions and the lack of a clear catalyst. Bulls highlight shrinking exchange reserves, stronger holder conviction, and the possibility of a sharp move once sentiment flips. However, one important piece is still missing. Institutional investors, the so-called smart money, remain cautious. Many funds prefer to see confirmation on the chart before committing serious capital. Without their participation, retail accumulation alone may struggle to turn consolidation into a sustained new rally. Big players still have the firepower to decide whether this becomes a full trend reversal or just another pause in a broader down move. Technically, the chart remains at a crossroads. Bitcoin is holding above a critical support area around the low 90,000 zone, but it has yet to reclaim and flip the 95,000 region into solid support. Only a decisive break and hold above that band would clearly invalidate the month-long downtrend and open a path toward the psychological 100,000 level. If whales and institutions step in while exchange supply stays tight, upside moves could accelerate quickly. Short squeezes can develop when derivatives traders remain positioned for downside while spot holders refuse to sell. In that scenario, even a modest positive catalyst could send price moving higher faster than most expect. But if support fails and price slips back toward the high 80,000 range, bearish sentiment may return and delay any major recovery. Weak hands could capitulate, and narratives around a failed breakout might dominate headlines once again, even though long-term on-chain trends would remain constructive. For long-term investors, this phase often offers opportunity rather than noise. Periods of low excitement and sideways trading have historically been when disciplined buyers build positions while attention drifts elsewhere. With fewer coins sitting on exchanges and more moving into cold storage and long-term wallets, the market structure can quietly strengthen even as headlines focus on short-term price frustration. Smart patience matters. For now, the data points to a simple message. Supply on exchanges is shrinking, conviction among holders is rising, and the next decisive move will likely come from whether large capital chooses to join the trend or continue to wait. This has been BlockBrief. Stay informed, stay ahead.